Hello and welcome back to this premium session where we are going to cover what market participants' behavior is. So, when they are having lower experience, what is their behavior? So, when they grow in their understanding and become experienced, or the investors who are from the institutional side, what is their behavior? So, we will see what is the difference and what we can learn from those differences in the behaviors. So, before moving there, let's understand the core dynamics of the markets. So, markets are not random, they are driven by the interactions between different types of participants. So, those participants are generally operating at different levels. So, one key constraint in the market is liquidity. So, when we say different participants are operating at different level, what do we mean? So, now let's look at this chart. Here, the market is going up. So, people are buying here. We will say people are buying here. But there are certain people who are selling. Then only buying is happening. If there is nobody selling, then where is the buying coming from? So some people are having the idea that market will go up. Some people will be thinking that in the short term they will be just selling here, they will be selling here, they will be selling, and they are expecting that market to reverse. And that's where we have buyer and seller making the market. So that's where we mentioned that different people operate at different scales, different levels. Now the key constraint in the market is liquidity. What is liquidity? Liquidity is simply like what is liquid? Liquid flows, right? So, in the similar way, when your buy order is coming and if it flows well in the sense that if a buy order is coming, then there has to be a sell order as well. Then only the matching happens. Suppose only a buy order is coming, but nobody is selling, then what will happen? There will be no trading. There will be no liquidity for the orders to flow. So, liquidity simply means presence of sufficient amount of buy orders and presence of sufficient amount of sell orders. That is liquidity. And why is it important? So we will understand this in a moment, why liquidity is important and for whom it is more important. So the key takeaway from this video is going to be that you will be able to identify key areas on the chart, and you need to understand where the large participants in the market are acting at which areas. Now, what is the behavior of less experienced participants first? So, less experienced participants, what do? They often generally enter into the directional moves. So, let's consider this move. This is a particular move which is on the upside. So, let's set up the context. The context was market was earlier going down, and after that there were indications that market might go further down or market may go up. There were both kind of indications. Now, if market goes here, then a person who was observing market at this point, he will say that market has moved up. Now, it might correct. And here we are talking about less experienced traders. So he will think that market has gone up. Now it is the time for correction because he does not understand the chart structure. So he will think that market might go down. And are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Then market goes up again. He thought that he will purchase here, but he did not purchase because he was fearful. He did not purchase at this point. Why? Because he thought that now market has gone up, it could be going down. Then market goes up and here he gets into panic. Now he is hoping that market should come down and then he will go for the value buying. And in that way market travels on the upper side, keeps on traveling on the upper side, but the inexperienced traders think that market will go down and after that they will invest. But once market goes down, because see, from market went down from here to here, so many people were waiting that market goes down from this point and then they will buy. But even at that point they did not buy because now at this point they were in hope that market will go up, but at this point of time they were fearful. So it is a typical behavior of inexperienced traders that they are not able to take the trade at right point of time. Now what will happen? Now market goes at this point of chart somewhere and then a FOMO, fear of missing out, starts to happen with the retail traders or the inexperienced traders. Now they will think they they have lost so much, right? There was an uptrend, but they have not participated. Now they further don't want to lose the charm of participation, so now they participate, they enter here, and market goes there, little bit of up, and then market goes down. Then a fear sets in, then they quickly sell it, and after that market may go up. So that's how retail traders or the inexperienced traders generally work in the market. They enter late, they exit early, and if there is some volatility, like we saw the volatility here, those inexperienced traders will be the first one who will lose hope from the market and exit. Now, conversely, what is the behavior of more experienced trader? He will take advantage of this point where the inexperienced people are selling. So market was going up, immediately inexperienced people sold it, and then here the experienced people bought it because they are aware of the market structure. If they think that market will go up, they will buy here. They will never panic with the downtrend. Now, very important aspect. Suppose a big trader comes up, right? And suppose he is looking at the market at this point of time. Now, suppose the volume, daily volume of the market is 50 million. Of this stock is 50 million. But a big investor comes with a 500 million. So first, he invests 50 million, suppose 40-50 million. He will get the liquidity here, but market price will go a little bit up. Suppose he invests further 50 million at this point of time. Market price will go further up. Then his next 50 million will be invested at this level. I am talking about if he is doing it in a single day. Then what will happen? His average cost of purchasing the stock will increase. So in the uptrend, generally they keep low volume, but they want those time frames when market is not moving up, it is not moving down, but it is consolidating, so that they have ample time to invest their small amount on daily basis, so that they build a good chunk in a particular stock. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So let's see that area. Let me make it little bigger. Now see, market has gone up this side. So once it has gone up slowly, so market participants were having small positions here. They were slowly participating, but they were waiting for this kind of consolidation. Market started to consolidate, and after some point of time, maybe this point and this point, or maybe after this point, they got the confirmation from the market that it is now in a consolidation zone. So it will, for a particular point of time, so market will remain in a consolidation zone for sufficient amount of time, so that they can buy here, they can buy here, they can buy here. So if we talk about previous example, when market volume is 50 million, a person wants to invest 500 million. So on daily basis, he will be investing 20 million, 40 million, 30 million. In that way, over a period of few days, he will be able to build their position on an average at this level only, because market is consolidating, and this is the golden time for the big pocket investors to invest. And after that, sooner or later, market is going to say that this zone is enough now and let's run up. So once it runs up, it just runs away, because then these participants who has invested here 500 million, even if he invests 25 million, 50 million once, then market momentum will pick up and he will gain for all of these positions which he has already taken. So this is the typical behavior of a experienced trader. Now generally, what is the behavior of a retail trader in this one? Now a retail trader comes and he has some view that market has run up very quickly. Now market has run up very quickly. He would be having expectation that market is going to give quick gains to him. Now market goes here and then he starts to get frustrated. Generally, these traders or the less experienced people who come in the market, they want quick gains, and generally they don't like to have that patience game. And then market goes up 1-2%, it goes up, and once it goes down, he thinks that now the uptrend has been completed and now let me jump out of the stock. They come out, they hope to some another stock. In the meantime, this consolidation range completes, and after that market starts moving up. But that retail trader or inexperienced trader jumps out of the market right at the wrong time, and he is not participating in this rally then. So that's the key behavioral difference between experienced and inexperienced traders. So we call these kind of ranges as accumulation zone, because now the market is accumulating here. So there are so many indicators which provide you the idea that how can you understand accumulation, how can you understand distribution. So you can use those indicators as well. If you look at this chart, this is the accumulation and distribution indicator. What is happening very simply here? So if market goes up, then at this point of time, the volume of that day is added here. If market goes down, the volume of that day is subtracted here. From that particular point of time, this line gets created. This is accumulation distribution line. So at this point of time, it is largely flat. That means it's accumulation going on in the market. Now here also it is largely flat. So market is seeing some accumulation or some distribution. Distribution also happens in that way. Now market has run up from this point to this point. Now here again there is a zone of consolidation which we discussed earlier. So market had accumulated a lot of stocks in the previous levels which we have seen. So in this zone we have seen that they have accumulated a lot. Now at this level some people will be thinking that now it's time for accumulation, but a lot of people who have good experience, who can understand charts, they will know that this is not the accumulation period, this is a distribution period. Distribution simply means it's the reverse of accumulation, but here again a volume is being sold slowly. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So here the volume of shares is being sold slowly. So now again the concept which we discussed about the large investors. Now a large investor who had got 500 million position here, right? So now he wants to sell. Suppose he sells in a single day. Market on that day itself will crash to a very low point and his selling point will be then becoming a downward spiral. His selling point will not be this one. His selling point will be this one for 50 million, this one for 50 million, this one for 50 million. So his average selling point will come somewhere in this range, and which is not desirable. So he wants to have a position where he can slowly lightens up his position. So he will sell some here, some amount here. So now entire 500 million portfolio he would be selling in this zone itself, and then he will be waiting for the correction and he will again buy at this zone and then go up. Now the key question is, how would a person know that this is a accumulation zone or distribution zone? Below it was the accumulation zone or distribution zone. So for that, if you want to understand all of that, then you will have to join the advanced courses. So Elliott wave theory is something which can tell exactly about such areas. What is your final accumulation zone? What is your final distribution zone? So what is the top which a chart has made? What is the bottom which a chart has made? So all of these answers can be provided by this Elliott wave theory. If you want, you can join my session. You can visit my website and join my sessions. Now the next important aspect which we should discuss is the breakout failure examples. So what is a breakout? Generally, a breakout simply means that if market has made a top and after that it has taken a correction, again it goes up and after that it breaks the previous high, then it becomes a breakout. If it attains the previous high and crosses it, then it becomes a breakout. Now let's understand this a bit. Market has gone up here. It has gone up and after that it has gone down, and this level has been created as a top. Now market goes down, it can go further down, it can go further up. So what we will do, we will try to identify what happens next. We will not guess from our side, we will try to read the market what it is doing. Now what market is doing, it has gone down, after that market is going up. Now we will carefully watch whether it is going to break this level or not. It has touched it this level, and many traders who are not having the patience, they will just buy at this level. They will think that market may go up. Once it breaks up, then there will be a huge rally, and that's why they take the position even before market has touched this top. But what happened? Market went down from this point movement itself. So what we should do ideally, we should be waiting for the breakout. So one candle once becomes available above this breakout, then only we should enter the trade so that market goes up. Now market again fell down. Here you can see there was some consolidation here because market was trying to go up, but it was not going up. Then suddenly market jumped because they have crossed this level. Now observe very important aspect. Now market has jumped here. So this much gap market has already taken. So if a person had taken a trade here, he would have gone directly to this level and he would have gone complete possible return. And that's exactly why some people were trying to take position here even before the breakout, because they understand, they have the market experience that once a breakout happens, then the stock goes really fast on the upside. So that's how it happens. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So this situation did not come here, but this situation came here. People built the position here and suddenly the jump came up. Now, when you are going to take a trade based on these fundamentals about the breakout, possible breakout and the resistance level, then what you should do? If you want to enter the trade in a position so that you take benefit of the breakout completely, then you have to build the position just before the breakout. But there is a larger risk that if market goes down, then you have to set up your stop loss. If market does not cross this line and falls by 1 or 2%, then you will exit. That kind of risk management you have to do. If market goes up, then definitely it is going to provide you very handsome returns. So that's how people look for the opportunities in the market. And remember, this is not manipulation. This is the behavior, collective behavior of large chunk of people, which is creating these resistance zones or support zones. So now let's just recap from the concepts which we have learned. You need to identify the key areas of interest. So key area of interest are these consolidation zones. When the market has shown the run up and after that it is consolidating, those are the key areas. Whether it is for buying or selling, that's another matter. And when there are some resistance zones build up because market failed to break out beyond a particular level. So these are the key areas of interest which we should see. So this is the area of interest for the resistance side and this is the area of interest for the support side, because market fell here and after that it is taking support at this level and then market is going up. So this becomes a support level. See, again market went down and this support is acting really well and then market goes up, and a person is able to make the profit if he is playing on resistance and support levels. That's it for this session, but you need to act on few things. You need to internalize a lot of these concepts. So what you need to do? Revise this video which I have spoken and then take few charts and identify where in the chart price has moved very sharply. Where is the period of consolidation? Where is the period of resistance? Where is the period of support level? So once you understand all of those aspects, then you will observe that you are building more understanding towards market, more understanding towards the chart. And if you do this thing on daily basis for few days, then you will be able to identify the structure of the market. So basically what you are learning through Uncover Markets is, it's not the theory, it is the applied market structure which you can do. And we are running several courses where we will be hand holding you, and if you are willing, you can enroll on those courses. So there are Elliott Wave courses which will completely define where the market is expected to take the bottom, where it is going to make the top, so that large chunk of returns you can take from the market. So those courses will have 3 to 4 months hand holding for you, complete hand holding, and you will be a master of chart reading skill, and investing in the market will become like a breeze. So thank you.